When the bank lends you £100,000, it does not move £100,000 from a vault to your account. No one goes to a shelf. No physical notes change hands. The bank opens a screen, types a number, and that number appears in your account. The money did not exist until the moment they typed it. This is not a conspiracy theory. It is how the banking system is designed. The Bank of England published a paper in 2014 explaining it plainly. The majority of money in a modern economy is created by commercial banks when they make loans. When a bank makes a loan, it creates a deposit of the same amount simultaneously. The asset and the liability appear together out of nothing. This is called credit creation, and it is the foundation of the entire financial system. To understand it, you need to understand what a bank actually is. A bank is not a warehouse for money. A bank is an intermediary between savers and borrowers, with one crucial twist. It does not need to hold your deposits in full before lending them out. It holds a fraction. This is called fractional reserve banking. The idea is simple. Not everyone withdraws their savings at once. On any normal day, a small percentage of depositors want cash. So the bank only needs to keep a fraction of its deposits on hand. Historically, somewhere between 3 and 10%, and can lend out the rest. But the mechanic goes further than that. When a bank makes a loan, the borrower typically deposits that money, or spends it, and the recipient deposits it. That deposit lands in a bank, which can then lend out a fraction of it, which creates another deposit, which creates another loan. The original deposit multiplies through the system. A single deposit of £1,000, with a 10% reserve requirement, can mathematically generate £9,000 of new loans before the system exhausts itself. Money is not moved through this process. It is manufactured. This raises an obvious question. What stops banks from creating infinite money? Several things. First, regulations. Central banks set capital requirements, rules about how much of their own money banks must hold against their loans. These limits vary by country and change over time, but they exist specifically to put a ceiling on credit creation. Second, demand. Banks can only create money when someone wants to borrow it, and borrowers need to believe they can repay. When confidence collapses, in a recession say, lending slows, credit creation slows, and the money supply actually contracts. Third, interest rates. Central banks set the base interest rate, which determines how much it costs for banks to borrow money themselves. Raise the rate, and borrowing becomes more expensive, and demand for loans falls. The system is not unchecked, but it is built on something that feels strange once you see it. The money in your bank account exists because someone, at some point, took out a loan. If everyone repaid their loan simultaneously, if all debt in the economy cleared at once, most of the money supply would disappear. This is why recessions can spiral. When banks stop lending, businesses cannot borrow to make payroll. Consumers cannot borrow to buy homes, and the money creation machine runs in reverse. The 2008 financial crisis was, among other things, a breakdown of exactly this mechanism. Banks had created enormous quantities of money against assets that turned out to be worth far less than the loans secured against them. When those assets fell, the loans went bad, the money evaporated, and governments had to intervene to prevent the system from seizing entirely. The intervention was, essentially, the government becoming the last borrower, borrowing and spending to put money back into a system that had run it down. Understanding this does not tell you what to do about your own money, but it does explain why economics is not like a household budget. A household cannot create money by lending. A bank can, and that difference shapes almost everything about the modern economy. Now you know.